Let's get into the advisory now. And as we know, managing superannuation can be complex, challenges ranging from risky overseas property investments to navigating taxation laws. To dumb it down for us or explain it better, Liam Short, SMSF Specialist Advisor at Sonas Wealth, joins me now. I wanted to start with the changes that are in front of the Senate at the moment. A lot of concerns here, Liam. What are you seeing in the potential implications to SMSFs?
Yeah, so the legislation's passed through the lower house and it's up now in the Senate, and they've rejected the amendment that we put forward to index the 3 million. So it's really going to affect a lot of small business owners, farmers, and the venture capital sector is really putting up a hard fight about this. Because it's looking to tax unrealised gains, it's going to be a major, a major effect on those areas, especially where people have lumpy assets that vary in price from year to year, depending, in agriculture, depending on the weather and their yields. For venture capital, depending on whether a company is ready to list or whether their product has been approved. So what we're finding is that there's certain sectors going to be smashed by this sort of tax. And the minister or the assistant minister tried to say that there are already other taxes that tax unrealised gains, like land tax and the goods in a small business, but they're nothing towards this. This is totally separate. It's looking at something and initiating a tax on unrealised gains, which is just something that we don't really or never really had in Australia, and it doesn't meet the pub test.
All right, it doesn't meet the pub test. What about when we're looking at direct property overseas in your SMSF? Is that a yay or a nay?
Yeah, I'm not even happy with where these inquiries are coming from, because it's people looking at what's happened in Florida, the floods in Europe, and what's happening in Lebanon now. People saying, well, could we invest in property over there when when it's being rebuilt and it's a good opportunity? But you've got to understand, an SMSF is a specific structure to Australia. Once you start going into a foreign jurisdiction, you're dealing with their legal and local laws, and you're also having to comply with the CIS laws over here in Australia. So on top of that, you've got exchange rate risks, you've got sovereign risks for some of these countries. So you just got to be really careful that it may sound like it's something you can do, but just because you can do it doesn't mean you should. And also, if you're going to look at something like that, you need to speak to your SMSF auditor beforehand and say, what are you going to require at the end of the year for me to be able to prove that this investment is owned by my SMSF? Because if you can't prove it, the auditor will put through a contravention report.
Let's talk about some superannuation platform providers clamping down on advice firms as well. I mean, we do like when people that are not doing the right thing get called out, but what are you seeing in this space?
Yeah, and I mentioned this sort of thing to you a couple of weeks ago, where there are these cold call firms that are basically offering people free super reviews, and then they sell that lead on to companies. And the only way a lot of these financial advisors that use these systems can get paid is if they consolidate someone's superannuation onto a platform where they can charge a fee. Now, that means that people could be on a very good, suitable platform or an industry fund where they're really doing well, but these people are able to do projections that show that they can offer a 10% plus return per year, and that it's much better for you to move. And what we're finding now is there's a bit of pushback from the platforms, which I think is great to see, but they're actually questioning it. And in some cases, they're actually stopping dealing with some financial planners that use these systems, and basically encouraging the people that have been involved in it, here's your fees back, get some decent advice from a quality financial planner. So, it's the platform stepping up to fulfill their legal obligations.
Let's talk about how much wealth some people have and how they're trying to distribute it. We talk about the intergenerational wealth transfer, but as we've talked about before, sometimes it's skipping a generation. For those boomers putting their wealth towards their grandchildren, how are they sort of getting around that, or how are they managing their super with that sort of transfer?
Yeah, so look, I just had a beautiful case where the laws can change in your favour over time. We had some grandparents that have been putting significant money away since each of the grandchildren were born. And the first one now has hit 21 years of age. And the grandparents want to see them sell some of those investments that they did for them. And they did them in trust. They've been transferred across at 18 into the name of the grandchild. The grandchild now wants to get some money out to pay for a deposit, but there's a huge capital gains. the money was invested in the S&P 500, and I think that's done about 15% per year for the last 20 years. So one of the beautiful things that's happened is that the new laws that came in a few years ago about being able to use your unused carry forward concessional contributions to put money into super, and that means that 21-year-old is able to trigger a capital gain of over 170,000, and it's releasing enough money for the deposit, and they're still able to put, using the 5-year carry forward provisions of the unused, they could put 167,500 into super this year and only pay 15% tax on that capital gain. So it comes back to the beauty of long-term compound interest, and just sometimes the tax system works in your favor.
That's amazing. I think my grandparents put into my Dollarmite account. Let's talk about the myth, though, of super. We talk so much about the so-called retirement age, but you can access it earlier than that, right?
Yeah, and I really want to talk about this because there are a large number of people now who have either helped their children or they themselves have got debt in their early 60s, and I'm seeing the stress of what's happening with the cost of living crisis. I had one person who was looking to retire just to be able to access their super. We sat down with them, and they didn't believe they could access them until 67. 67 is the pension age. When it comes to superannuation, the important factor is the preservation age, which is for most people now is 60. So we were able with that person to start them a transition retirement pension, which took out 10% of their balance of super, which not only helped pay down their mortgage payments, but also allowed them to salary sacrifice this year into super, so that next year they will have the tax savings when they do their tax to help pay the mortgage next year. So they're always, don't believe what you hear from friends or that you just read on the internet. Get some advice, because even in your most dire situations, there are usually a solution that can work for you.
And another point, Liam, as well, that we're looking at is the gap in estate planning. You're saying this needs to be addressed. Who by, and how?
Yeah, look, the thing is, it needs to be a lawyer that actually does the estate planning. But most people, I honestly tell you, most people are scared to go to a lawyer because they're not sure what they need or what to talk about. Their accountant or their financial advisor has been a trusted long-term advisor to them, so they're more comfortable talking with them. So I think it's time now that we as accountants and financial planners have to step up and discuss this with our clients, because a lot of them have saved hard, they've worked hard, they've invested well, but they just don't know how that money's going to transfer to the next generation the way they want it. If they do proper estate planning, they can decide who the money goes to, when it goes to them, and how it goes to them, depending on the circumstances. So I think it's time for the teamwork to come together again, where the accountant and financial advisor starts the conversation with clients, guides them on the initial education, and then passes them to a qualified lawyer to do the actual documentation and the estate planning for them.